Rating Nation, I'm Seema Modi. There is a big divergence brewing in the currency market. The U.S. dollar index near its lows of the year, while the Chinese yuan rallies to three-year highs as investors bet on further strength in the world's second largest economy. Let's discuss this divergence with Bill Baruch of Blue Line Capital, John Petrides of Tropeville Asset Management. John, your thoughts on investors betting on China's comeback?
Well, I think I take it from the opposite view. I think the U.S. dollar has been stubbornly strong for the past couple of years, and it's been recently where we've seen some weakness, and I think much anticipated weakness that investors have been waiting for. And, you know, one of the ways that we've been able to play it, ironically, I know this is usually an equity-focused show, but is through the fixed income market for our income strategies, where we use the VANECK JP Morgan Emerging Market Local Currency ETF. Here you're getting near a 5% yield, and you're investing in emerging market bonds because the world is less fearful about credit risks today than we were a year ago. And it's based on local currency, not U.S. dollar based. About 10% of this ETF is geared towards China. So you do participate in this trade that we're talking about here today, and you pick up some yield in what's been a stubbornly low yield market.
Bill, do you think the U.S. dollar is due for a comeback now with the Fed expected to raise rates sometime soon?
Listen, the dollar can bounce, but I think there is a bigger story. And, you know, talking about the Fed, let's get through that non-farm payroll number next week. Really what we have on our hand is a multi-year, pretty much a decade-long downtrend being broken out to the bullish side here for the Chinese yuan against the dollar. And the Chinese yuan, you know, their currency is going to travel farther for them, allow them to buy more commodities. And everybody's been pretty aware that, you know, China being a bellwether for the recovery through last year. What you're seeing here right now is now them talking down some excessive trading, excessive speculation in commodity prices. But I think the same way you're looking at like a Goldman Sachs or other banks talking their book, China's talking their book too. They're talking prices down if they can because they want to buy more. And now their currency travels farther. I like being long copper. I like being long in the metals like gold. I like being long energies. So copper, I do own call structures in the underlying commodity. But take a look at FCX. You got a nice little uptrend there, wedging out. I think that could break out to the upside. Take a look at GDX. Look at the miners. They give a nice bull flag or a flag pattern that's after this market rallied really nicely out of March. That really could have some good upside there. And then energies. I mean, China demand for energies is very well known. I don't think it's going anywhere, although there's times where it softens a little bit. But I think you're looking at crude oil. I mean, Goldman Sachs themselves even said 80 bucks is in the card. So I think crude oil is about to break out. You know, we're at the tail end of a very seasonally, you know, bullish time here. So there's upside in commodities in general.
And a lot of different ways to trade it. John and Bill, thank you for joining me today. And thank